Dealers. Could there be untapped revenue on your lot? Protective Asset Protection works with dealers to unlock new revenue streams through reliable protection products across most vehicle types. Visit protectiveassetprotection.com/automotive news to learn more.
Welcome to Daily Drive for Wednesday, May 6th, 2026. I'm Kellen Walker in Las Vegas. Today on the show, Lucid reports $1 billion loss and suspends production guidance. GM gears up for gasoline trucks at its Orion plant, and hybrid demand surges as fuel prices climb. Plus, Automotive News managing editor Jerry Hirsch makes the case that the U.S. needs its own EV industrial policy to counter China, which includes bringing back the federal EV incentives.
In a perfect world, the government should not be in the business of picking winners and losers, but it already is.
Let's run through all the news you need to know to keep up in the auto industry. Lucid's first quarter numbers tell a rough story. The EV maker reported a $1 billion net loss, more than double the $366 million it lost a year ago. Revenue did go up 20%, but it still missed Wall Street's expectations by a lot. Analysts were looking for $440 million, far more than the actual result of $282 million. Part of the problem? Lucid built 5,500 vehicles, but only delivered about 3,100. Gravity crossover sales took a hit after a recall over a rear seat defect. We'll have more on this story in a minute with our own Lawrence Iliff. General Motors is gearing up for a second quarter launch next year at its Orion assembly plant, and the plans are pretty ambitious. GM's telling suppliers it wants to scale production to 190,000 gasoline-powered trucks and SUVs a year. That's about 2/3 of the plant's capacity. The factory was supposed to be all electric, but GM switched back to traditional gas engines amid tariffs, rolled back emissions rules, and cooling EV demand. The automaker's also eyeing hybrid powertrains, but hasn't pulled the trigger on that yet. And new vehicle inventories fell to about 2.8 million at the start of May, down 2.7% from the beginning of April. That's according to data firm Catalyst IQ. Hybrids are flying off dealership lots faster than anything else. They're spending just 59 days in inventory, compared with 75 days for gas-powered vehicles and 114 days for EVs. The reason? Elevated fuel prices are driving demand for hybrids and electric vehicles to record levels. And those are today's headlines. You can find more details on all those stories at autonews.com. Joining me now to talk more about Lucid's grim earnings report is Lawrence Iliff, who covers Lucid and other EV makers for Automotive News. Lonnie, welcome back to Daily Drive.
It's great to be here.
All right, Lonnie, billion-dollar question. Is Lucid in real trouble?
You know, I was looking at some of the analyst reports today, and I think some people do think they're in real trouble because they keep burning through cash. This is, $1 billion net loss, negative 110% gross margin. They're losing about $100,000 a car on a gross basis. And they're down to about, I think they said 4.7 billion if you include like money they raised recently. And they say that will take them to mid 2027, right? So that's, 5 quarters, 4 quarters, 5 quarters. And then they have to make their, third vehicle, scale it up in a new factory in Saudi Arabia. And, it's a heavy lift. They went through their original CEO and he left about a year ago. Peter Rawlinson, kind of the founder CEO, the Elon Musk of, Lucid. And then they had an interim CEO for a little over a year. And now just last month, they have a new CEO who comes from Schindler, the elevator maker. So there are some people sounding the alarm on Wall Street for sure.
Now, Lonnie, the company still has over $3 billion in liquidity, but how long can Lucid keep burning through cash at this rate?
Right. So that was at the end of the first quarter, and they raised some more money. So now they think they have $4.7 billion in liquidity. And basically, they're saying kind of in an optimistic way, right? That will take us through the launch of our next vehicle, our third vehicle, the mid-size Cosmos, which is priced at like 50,000 rather than their like average selling price now of, 90 or 100. And that will get us to the next level, next phase. That's our next booster rocket. So they say that they have enough money to get there, right? And then we'll have to see how that car sells, whether they can produce it efficiently in Saudi Arabia because they're building a plant there. Even if they can get it out on time, because they suspended, their guidance on how many cars they would make this year. It was like 25,000 to 27,000. They said, well, we don't know about that. We want to recalibrate in a quarter, at the end of the second quarter, we'll tell you. And they also might push back that factory a little bit. They kind of hinted at that don't be focused on like a late 2026 start of production. Be more focused on 2027.
Perfect. Very insightful. Lonnie, thank you for joining me.
Thank you.
Coming up next, Automotive News managing editor Jerry Hirsch argues for bringing back federal EV tax credits to counter China. That's next on Daily Drive.
Dealerships today face tighter margins, shifting consumer expectations, and affordability pressures tied to broader economic uncertainty. At the same time, consolidation and digital retailing are changing how products are sold and supported. That's why many dealers are re-examining how asset protection fits into long-term profitability and business goals. For more than 60 years, Protective Asset Protection has worked alongside dealerships across the country, delivering trusted F&I solutions like vehicle protection plans, maintenance programs, limited warranties, guaranteed asset protection, and more, helping dealerships generate revenue while helping customers protect what matters most. In addition to protection products, dealers have access to programs, tools, and proven training designed to support a wide range of business models. From digital retailing capabilities to dealer wealth building programs, Protective's approach is centered on partnership, giving dealers the flexibility to explore what fits their operation today and how it may support growth over time. If you're a dealer and interested in tapping new revenue streams through protection products, get in touch. Visit protectiveassetprotection.com/automotive news. That's protectiveassetprotection.com/automotive news.
Welcome back to Daily Drive. I'm Kellen Walker. China subsidizes its auto industry in dozens of ways, from cheap credit to favorable trade policies, all part of a strategic effort to become the world's biggest auto exporter. Automotive News managing editor Jerry Hirsch argues in his new column that the U.S. needs its own industrial policy to counter that threat, including bringing back a $5,000 tax credit for EVs under $50,000. Jerry spoke with our own Jake Neer about why he thinks the U.S. can't afford to be complacent.
Jerry Hirsch, welcome back to Daily Drive.
Glad to be joining the podcast again.
All right, so let's set the stage right off the bat. Remind listeners how much China subsidizes automaking and what that actually looks like.
Well, I don't have a dollar figure, but they do it in a lot of ways. First, really cheap credit to a bunch of automakers, incentives for purchases, labor standards that are far lower than ours and that some would judge to be exploitive, favorable trade policies to enhance exports. There's just dozens of ways, because this is a strategic move for them to essentially be the major auto exporter globally.
You write that the U.S. auto industry faces a choice here when it comes to China. What is that choice?
Well, we have this problem in the United States, and we have this incredible, wonderful infrastructure based on combustion engine technology with a gas station in every corner, and it screams convenience and ease. Even now with the Iran war, wow, gas prices are at $4 plus a gallon in many parts of the country, a little bit higher in some areas. But compared to what's going on in the rest of the world, we have just not felt the brunt of it. We have this huge oil supply that's continuously replenished, but that's not where technology is headed. And in fact, the Iran war is only going to push electric vehicle adoption in the rest of the world, because they don't have the luxury of much lower gas prices. Yet electricity can be made from so many different sources. Yes, China is a big coal burner, but they also have tremendous wind and solar power energy generation, and it's only increasing year by year, month by month, week by week. So they're moving in a direction of energy independence from fossil fuels. They're providing huge incentives to their auto industry, and they have this strategy essentially to take over the global auto world. So we have to recognize that we just can't sit still and say, oh, yeah, we have this wonderful system that's really convenient and great. Let's continue. We have to move in the same direction, which is why we need some sort of strategy and industrial policy to counter what China's doing. People will say, well, it's not fair. Yeah, it's not how a market based economy works, but we're in a global economy. We have to be realists and pragmatic.
So you actually make a pretty specific proposal here that the government should reinstate at least a $5,000 tax credit for EVs under $50,000. Talk about why that amount and sort of why that you think that's important, even though we've gotten away from the government subsidizing these vehicles.
Well, we have to recognize that all things being equal, consumers are going to gravitate probably to hybrid vehicles because that's a step and it saves them money at the pump. But we still need some sort of pull for them. And we have this huge affordability crisis in autos in the United States. Insurance is incredibly high, maintenance and repairs have gone up. All the stuff's gone up at faster than the rate of inflation, which has already gone up pretty much. And the average vehicle price now, the transaction price, is around $50,000. So the previous credit, federal credit, was $7,500. I understand we can't be printing money. We have huge budget deficit that grows and grows and grows, but we do still have to think strategically. So I propose the $5,000 because one, it's less. It's at 10% of the average transaction price of a vehicle. If people can get 10% off the price of a car right away, perhaps then that'll be a pull toward EVs. And it also creates a market for our automakers here in the United States to push forward with investment plans and development, which they've practically abandoned in most cases. There are some exceptions. Yes, Ford is doing this project in Long Beach to build a low-cost EV compact truck. I'm sure GM still has EVs in the market. I'm sure they're still doing research. But we need to create a friendly environment for that to be successful. And so that's why I picked this number. I also suggest that it sunsets in 6 years. So we're not disrupting the market in one direction forever. I think over that time, our charging infrastructure will be really good. We will have made improvements to the grid, not because of EVs, but because of data centers. But the EV transition can piggyback on that. And we'll be in a much better situation where an EV will have the convenience of a gasoline car. There's another reason for this, is that EVs lend themselves to this electric software-defined architecture. You take out the combustion chambers, the pistons, the hydraulics. You could have brake-by-wire, steer-by-wire, electric braking calipers. Some of the developers are saying they'll last 150,000 miles. Clearly, the next generation EVs are going to have far less maintenance than a combustion engine vehicle. So again, we're helping our consumers by lowering their cost of ownership.
You've already brought up the argument sort of against what you're talking about here. So playing devil's advocate, I'd like to pull this a little bit more. Many manufacturers and dealers will say and have said that we need to sell what U.S. customers want to buy. Why should the government be in the business of picking winners and losers?
Okay. In a perfect world, the government should not be in the business of picking winners and losers, but it already is. Look, we have this deal where we own a slice of Intel. We're getting money for the chips that NVIDIA sells to China. We get a commission on that. We have industrial policy in 50 different directions of this country. So if it was a level playing field and we weren't picking winners and losers, boy, this argument would make a lot of sense. But when we're seeing another country pick winners and losers in an effort to take over the global auto industry, The Trump administration instituted all these tariffs, including on cars and the materials that goes in the cars, for national security reasons. Okay, well, wouldn't there be a national security reason to have our vehicles lead the electric vehicle transition so that we know there's security in the software and the communications devices embedded in these vehicles? I mean, you can make this argument in 6 different ways, but at some point, again, you've got to be pragmatic and look at the reality of global industry and the global markets.
I also think, though, about what we're seeing in places like the EU, other markets where they've tried a lot of these things more aggressively, even than the US was before. I'm curious how you sort of view how you think this would play out here versus, in Europe or other markets where we see China has already very much come into those markets and is challenging the local automakers in really existential ways.
Well, if BYD could get in here with a $35,000 EV that can go 300 miles per charge, game over. All of the budget market's going to gravitate to that. In the end, people walk with their pocketbooks. And if they think something's going to save them a ton of money, they're going to do that. So the thing that I'm suggesting is kind of a half step. Let's foster and nurture this market a bit so that we're not siloed, so we're not a global island of combustion engine technology when the rest of the world is transitioned to EV technology and has better cars that they're selling for lower transaction prices.
All right. So before we go here, we heard at NADA this year in Las Vegas predictions that Chinese automakers could find their way into the US market as soon as this year. Do you think there's still time to implement real industrial policy to counter China?
Yes, I don't think they're going to enter this market in any substantial volume this year. The only way they can enter this market at this point is people buying them and bringing them across the border. There's some loopholes and things from Canada, which is just going to start selling Chinese EVs, and Mexico, which already has them. And we're already seeing some of these EVs in the border areas. So I think we have time. That we have these huge restrictions on Chinese imports. Really, the only way that they can enter the market soon would be in partnership with a legacy automaker, essentially Ford, GM, or the American unit of Stellantis, or to buy a plant, buy excess capacity and launch a plant here. And at that point, they lose a portion of their cost advantage, not its entirety, because they'll have to pay for U.S. labor rates and create a supply chain, and there'll be investment capital that they would have to put into it. But they could still probably undercut our prices and come out with some really good budget EVs for those who can't afford to buy a new vehicle at this point.
Jerry Hirsch is managing editor of Automotive News. His new column is U.S. Needs Its Own EV Industrial Policy to Counter China. Jerry, always great having you on. Thanks so much.
Thank you, Jake.
That's Daily Drive for today. I'm Kellen Walker. Thanks to our own Lawrence Iliff and Larry Velaquette for their reporting for today's podcast. We also had reporting from Kurt Nagel of our sibling publication, Crane's Detroit Business. You can get the latest news on EV policy, Lucid struggles, and everything happening in the auto industry at autonews.com. We'd love to hear from you. Let us know what you think of the show and the topics we covered today. Send us an email at dailydrive@autonews.com or leave us a voicemail at 313-444-2774. And if you enjoyed the podcast, remember to like, leave a review, and subscribe so you never miss an episode.